Hello folks, welcome into today's video. The chef is moving. The chef is moving up again, over 3% here today. I have found something in regards to chef that I want to show you guys and share with you in this video. In today's video, this is something that's not just in regards to the chef. You're going to be able to apply what I'm teaching in this video to future stocks as well. And I think this is very, very important. Sometimes I make videos around a certain stock, but a lot of times they have lessons inside them. And that is exactly what this video here is today. So make sure you're not just thinking about this in regards to chef, and you're thinking about these points I'm going to make in this video in regards to judging future stocks. As always, hope you guys enjoy this video. All I ask in return is that you smash that like button for the YouTube algorithm. I appreciate you guys for joining me as always, okay? So we're going to talk about a couple other stocks in this video as well. We're going to talk about this Oatly company, which you might have heard of this company. They went public in the past year or so. A highly hyped stock. Oat milk company, okay? They make oat milk. That's their main product. If you ever heard of this company, you've probably heard of them from their oat milk. They're also getting into some other product categories. They have some dessert products. They also have some Ogurt products, okay? Ogurt, okay? I guess you can call it like Ogurt. That's what they call it. Okay, so they get into some other products. But anyways, this is a company that went public in the past year. Super popular stock in terms of like, you know, the hype around it. Let's just put it that way. And we'll discuss that one in this video. And we're also going to discuss Beyond Meat in this video as well. And it's all going to kind of make sense when all these pieces kind of come together, which Beyond Meat is also another plant-based food company, just kind of like these two other companies, the Oatly company, and then obviously Tattoed Chef. And Beyond Meat is a stock I owned in the past. Definitely a stock I like. It's just honestly Tattoed Chef's, you know, in my opinion, a much, much better stock for the next 5 to 10 years. Okay, so in this video, what you're going to find out is you're going to find out the chef is actually cheap. What you're going to hear from a lot of short sellers out there are people that, you know, don't like the stock for whatever reason it is, right? You're going to find that they're going to say, oh, it's overvalued. It's a ripoff. It's not a deal. Things like that, okay? And I think what I'm going to be able to show you guys is, you know, how this stock is actually pretty darn cheap. And what you're going to find is these exact principles you can use in future stocks as well, which I think is really, really important. It's a great day for the chef. Congrats to anybody that owns a chef. I think, you know, just a small lesson here in regards to chef. I mean, look at that. We're up 6 figures now on this stock after being down on it very, very recently. You know, I think a couple good lessons. One, always keep some cash around to buy on dips, right? Of stocks you love, kind of like I've done with the chef. The second thing, and this is really, really important, okay? Things can change really fast in regards to stock prices. The fundamentals of companies, as long as the fundamentals are going great for your companies, the stock prices will reflect that over time. And sometimes, you know, a company's doing great, they can report great growth, and the stock will fall a bunch. And it is what it is. But over time, in the end, the stock price will reflect where the company fundamentals go over time, okay? So this is just something very, very important to keep in mind. We got a brand new course out. It just launched literally a couple hours ago. If you haven't got to check it out yet, which you probably haven't because you've never even probably heard of it before, How to Invest Like a Pro in 24 Hours or Less, check out the pinned comment down there and apply for that course. I hope you guys enjoy that as always. Alrighty, there's 2 ways to figure out if a stock is a great deal or not. These are the 2 main ways. There's a few other ways you can kind of do, but these are 2 main ways to figure out if a stock is a great deal or not, okay? The first one is how many years will it take for a company to make its market cap back in net income, okay? Once again, how many years will it take for a company to make its market cap back in net income? For example, okay, let's say you pay a $1 billion market cap for a company. Let's say XYZ Corporation is trading at a $1 billion market cap. If that company is going to take over 30 years to make $1 billion of net income, you are getting flat out ripped off on that stock, okay? Like, if the, you know, it's going to take more than 30 years, no, you're getting a very, very bad deal, okay? Now, also to figure out what a company's earning 10 years from now, 20 years from now, 25 years from now, that's definitely a big, big challenge, right? But if you're running numbers, you know, many, many years out, and you're like, dude, this might take me over 30 years to get the net income, that's obviously a bad thing, right? If you run numbers on where you think that company's going over the coming years, and you see that it would take about 20 years worth of net income to basically, you know, equal its market cap. Then you're talking, okay, we're getting more interesting. 15 years and you're really starting to talk, right? 10 years and you're likely getting a great deal. If a company in 10 years can basically make its net income back of that market cap, that's a great deal. Now, If it's 5 years, then you're talking about you're getting a steal deal more than likely, okay, on that dang company, okay? So the problem with this strategy is it's very hard with high growth stocks, right? It's much easier to run Johnson & Johnson numbers, even though no one really knows what Johnson & Johnson is going to be earning 10 years from now, right? But it's at least easier to run Johnson & Johnson numbers and try to figure out if that's a good deal or not, because it's a company that's consistently profitable. It's a nice money maker. It's a business that's been around for 100 years. High growth stocks, much more difficult. Much more difficult to do that strategy on, okay? So the second main way is you want to compare it to its peers, right? You want to compare that company to its peers out there, meaning it's not even necessarily as competitors, but companies that are somewhat in the same industry around roughly the same growth rates, all right? And the two things I like to compare are the forward price to sales ratio, right? Because sometimes if it's a super high growth stock, they might not have a PE on it yet. So if it doesn't have a PE on it yet, that makes it difficult. So you kind of got to do a forward price to sales ratio if you're comparing companies. And then I like to look at the growth rates of those companies. What's the revenue growth for that company? So forward price to sales ratio, growth rates, okay? Now, here's where many people get this wrong. And I think this is very, very important to address, because a lot of people get this wrong and they find themselves into a situation where they watch stocks go up hundreds of percent or thousands of percent, and they're on the sideline scratching their head and they're like, what the heck, man? I thought that stock was an overvalued ripoff, and then it just, went up another 500%, 1,000%, things like that, okay? Where they get it wrong is they try to compare any company against any company because they might sell similar products. For instance, the short thesis around Tesla all the time back in the day was, it might even still be today, but especially many years ago, was people would compare Tesla to General Motors or Ford or Volkswagen or other car companies and be like, well, this company trades at this price to sales ratio or this Ford P, and Tesla doesn't make. You can't do it like that, right? Tesla's growth rates are so much different, and also they have a lot of different business lines that GM doesn't have. They're a horrible comparison. To compare Tesla to GM makes absolutely no sense. And anybody that's on the long side definitely understands that. The shorts will argue that, and they think Tesla and GM should be valued the same. And it's like, this isn't the way this works, man. Or at similar metrics. And it's like, no. That's just not the way it works. I did this in my first few years of investing with Amazon. I looked into Amazon. I really liked what I saw with the company. But I looked at this valuation. This is probably in my second or third year of investing. And I looked at it in relation to Walmart, and Walmart's metrics were so dang cheap compared to Amazon. And so I ended up investing in Walmart rather than Amazon, even though I liked Amazon's business model way better. Well, early Jeremy just didn't understand that Amazon's growth is significantly different than Walmart. Amazon's opportunity over the next 10, 20 years was significantly more than Walmart. Walmart was already a well-established, built-out business. And Amazon was on the cutting edge of e-commerce, which is where all of us were moving to, right? Plus, they had this Trojan horse that would end up becoming a massive business that not a lot of people saw, which was Amazon Web Services, right? And so, that's a mistake I definitely made in my early years. It makes no sense to compare Amazon to Walmart. They're not the same business, especially if you're talking about when I was looking at this company, 2009, 2010, years like that. No way should those companies be compared. You can't compare Apple to Sony. You might say, well, both these companies make the most of their money from selling hardware products, right? In electronics. You can't compare them that way. Apple's a completely different business model than Sony. How they get their revenues, how they generate their profits, all those things. You can't compare those, right? And so a company like TTCF, you can't compare Tattooed Chef versus a traditional food company. The growth rates are massively different. Tattooed Chef is in front of a trend that's not dying down anytime soon. Is going to get more and more popular, which is plant-based food products, while traditional food companies are selling to a market that is shrinking, in my opinion, and will continue to shrink over the coming years. And a lot of those companies are already stagnant on growth or are going to start going negative, versus Tattooed Chef has massive gargantuan growth ahead for as long as I can see, right? So you can't just compare any company to any company in these spaces, because they all have these very, very different business models and very, very different growth rates, okay? So, if it makes the most sense, if we're going to compare Tattooed Chef, we're going to compare it to a couple companies. We're going to compare it to Beyond Meat, and we're going to compare it to that Oatly company that went public in this past year, right? And if we look at Beyond Meat, this is a company that has a $7.6 billion market cap. So if we're going to figure out its forward price to sales ratio, we need to divide the market cap by essentially the average analyst estimate for where revenue should be in 2021 for this company, okay? And what we're going to find is we're at about a 13.7 forward price to sales ratio for Beyond Meat, okay? And Beyond Meat is supposed to grow 35% plus this year. So very, very strong growth. Obviously, a very, very high forward price to sales ratio here, but it's all relative, right? If this company continues to put up 35, 40 type percent growth numbers for years and years to go in the future, that price to sales ratio is going to come down in a massive, massive way really, really quick. And then all of a sudden, if they start posting, very profitable numbers, obviously the valuation can start to make a lot of sense really dang quick. Right now, it definitely looks like it's valued on the high side, right? But these numbers are important to remember here, okay? That 13.7 forward price to sales ratio, keep that in mind. Make a mental note of that right now. And the 35.8% revenue growth, make a mental note of that, okay? Oatly, okay? Oatly. Well, Oatly has over an $11 billion market capitalization on this company right now. If I recall, they're supposed to grow about 64% revenues this year. If you go ahead and look at their market cap and divide that out by that revenue number expected, company's at about a 16 forward price to sales ratio right now. A 16 roughly, all right? So, and once again, 16, and keep in mind that's 64. Now, what is a company like Tattoed Chef at? Well, you would think if you heard from the short sellers, you would think it would have to be right up with these companies, if not actually much, much more than these companies, right? What if I told you that the forward price to sales ratio for Tattoed Chef is actually quite a bit below these companies, okay? Tattoed Chef is at a $1.7 billion market cap today. 61% revenue growth expected in 2021, right? $239 million of revenue expected. That puts the company at a forward price to sales ratio of 7.1. A significant difference between Tattoed Chef and where Oatly's valued and where Beyond Meat's valued. Okay? A significant difference, needless to say, right? So the recap here is Tattoed Chef is far cheaper than Beyond Meat. And basically is way cheaper than Oatly, right? So it's far cheaper than Beyond Meat. It's way cheaper than Oatly. It has way stronger growth than Beyond Meat, right? Because Beyond Meat, what did we see there with Beyond Meat? Beyond Meat had 36% revenue growth roughly. Tattoed Chef is expected to grow over 60%. So which means that growth is about in line with Oatly, okay? This is very, very important to keep in mind. Tattoed Chef, far cheaper, and it has inline growth with Oatly and is way stronger growth than Beyond Meat. Now, we don't even have to get into the fact that Beyond Meat sells into a product category that traditionally gets very, very commoditized, right? And really, it's hard to build brand strength there of meat products, right? They're plant-based meat products, but if you look at traditional chopped meat and whatnot, steaks, things like that, it's hard to build brands there, right? Stores just start selling their own brands, and that's kind of the way it ends up starting to become, right? And then if you look at a situation like Oatly competing in the milk category, almost everybody I know just buys whatever milk is the store brand milk, right? Maybe it's going to be different for Beyond Meat and Oatly long term. Maybe they're going to be able to have super strong brands, but it's at least worth noting that, right? Tattoed Chef already competes in the frozen food category, right? And they want to get into the snack category. And so if you look at the company in the frozen food category, brands are very, very strong in those markets, right? It's not easy to build a super strong brand, but if you go down the main freezer aisles, it's all big brands there, right? You can actually build a successful brand. Same thing with snacks. Store branded TV dinners or frozen food and store branded snacks don't sell great, okay? Branded frozen food products and branded snacks sell great. That is something we know, right? And so these are some other factors just to kind of keep in mind here, right? And so think about it this way. If TTCF stock, if Tattoed Chef 2x'd its stock price tomorrow to $40, okay? The stock doubles tomorrow. It's still cheaper than Oatly on a forward price to sales ratio. And it would be right near Beyond Meat. And that's if the stock price doubled tomorrow. This is some food for thought here. And this is why I feel so dang comfortable continuing to buy Tattoed Chef very, very heavily over the past month. And especially when it took that dip all the way down to 16 bucks, I was buying heavily. Because at the end of the day, I'm looking at the valuation of this company, right? And I'm looking at where peers are valued in this space. And I'm thinking about where Tattoed Chef's going over the coming years, where that net income for the company is going over the coming years. I think about the index fund money that will be coming in this space over time. I think about maybe even ETFs that are plant-based over time that have Tattoed Chef, Oatly, Beyond Meat, some of these other companies all in there. Maybe even a company like Very Good Food Company, right? Having all those companies kind of in its own like ETF, and I think about how much that would benefit the company over time. And so needless to say, yes, the Chef is actually much cheaper than a lot of companies out there that compete in the same space, and they have near as good a growth or actually better growth than a lot of those companies while being much cheaper, guys. So yeah, that's why I love this stock. And also this is a great video for comparing in the future in terms of other growth stocks and trying to figure out, am I getting a good deal, bad deal, things like that. If you want to learn directly from me and basically check out our brand new course we got there, how to invest like a pro in 24 hours or less, check out the pinned comment down there and enjoy it. Much love as always, and have a great day.